Mastering business interruption insurance. Your business interruption insurance may not cover where you need it most. When do the geographic restrictions or territorial limits of the business interruption insurance policy apply, and what specific areas or regions are affected by these limitations? Geographic restrictions or territorial limits of a business interruption insurance policy are clauses that define the specific areas or regions where the policy's coverage is applicable. These restrictions are crucial as they determine where the insurer will provide compensation for business interruption losses. The geographic restrictions or territorial limits of a business interruption insurance policy typically apply to the location of the business premises, the location of the damage or disruption, or the location where the insured event occurs. For instance, a policy may specify that the policyholder is only covered for business interruptions occurring at a specific location, such as the insured's primary business premises or a specific geographic region. These limitations can affect various aspects of the policy, including the definition of a covered event, the scope of business interruption losses, or the extent of extra expenses incurred during the interruption period. The specific areas or regions affected by these limitations often include specific countries or territories. Policies might exclude or limit coverage for business interruptions occurring in countries or territories that are deemed high risk or have unique regulatory requirements, such as sanctioned countries or areas with high political unrest. Regional or zonal exclusions. Insurers may exclude coverage for business interruptions occurring in specific regions or zones, such as flood-prone or earthquake-prone areas, due to the elevated risk of natural disasters. Proximity to high-risk areas. Policies might exclude coverage for business interruptions occurring near high-risk areas, such as airports, ports, or critical infrastructure, where the risk of disruption is elevated. In some cases, the geographic restrictions or territorial limits may be defined by the policy's territorial limits clause. This clause outlines the specific areas where the policy's coverage is applicable, and any excluded areas or regions. For example, a policy may state that it only covers business interruptions occurring within the continental United States, excluding Alaska and Hawaii. To navigate these geographic restrictions or territorial limits, policyholders must carefully review their policy documents and understand the specific areas or regions where their coverage is applicable. This knowledge is essential to ensure that the policyholder's business is adequately protected against business interruptions, and to avoid any potential disputes with the insurer in the event of a claim.